There are 6 companies sitting on the market right now that I genuinely believe most investors are going to look back on 5 or 10 years from now and ask themselves why they did not buy more when the prices were right there in front of them. And I say that not to hype anything up or make a bold prediction just to get your attention. I say it because when you actually sit down, go through the growth rates, the margins, the competitive positioning, and yes, the very real risks attached to every single one of these names, you start to see a picture that most people walking past these stocks right now are simply not paying attention to. That is what this channel exists to do. Cut through the noise, find the signal, and give you the honest, research-backed perspective you can actually use when thinking about your own portfolio. So if you have been sitting on the sidelines wondering where your money should be working harder for you right now, stick with me for the next several minutes because what we are walking through today genuinely changed the way I am thinking about my own holdings. If you are new to Ticker Hawk and this is your first video with us, hit that subscribe button right now. This is exactly the type of deep research content we put out consistently. No fluff, no clickbait, just real analysis for people who take their financial future seriously. All right, let us get into it. The first name on this list is Robinhood Markets, ticker symbol HOOD. Now, before you move on, let me say something directly. Understand the skepticism. A lot of investors looked at Robinhood a few years back, saw the revenue volatility, watched the turbulence around certain market events, and decided this was not a serious business worth their attention. That instinct made sense at the time. But the company you are looking at today is fundamentally different from what it was even 2 years ago, and the opportunity forming in front of it is one of the most compelling setups I have seen in retail financial services in quite a while. SpaceX recently completed its IPO and almost immediately became one of the most valuable companies in the entire world, surpassing Microsoft to claim the 4th largest spot globally. That kind of event creates a massive wave of retail engagement, and Robinhood sits right at the center of that wave. It is where millions of Americans turn first when something this significant happens in the market. If you look at first quarter numbers in isolation, yes, transaction volume came down, the macro backdrop was rough, and it simply was not a great environment for active trading. But in April, May, and early June, the company reported figures tracking as the strongest they had ever seen across equities, options, and prediction markets combined. That is not a company stumbling. That is a business snapping back with real force. But here is what I want you to really internalize, because this is where the long-term case gets genuinely exciting. The reason I hold Robinhood is not primarily because of volume spikes around big IPO moments. It is because of what is sticky in this business. Robinhood Gold, their subscription at $5 a month, is the perfect example. Once people sign up, they do not cancel. Gold drives higher asset deposits, higher adoption of retirement accounts, and deeper engagement across the whole platform. The retirement product in particular does not switch off when markets get volatile. People keep contributing regardless, and that creates a compounding recurring revenue base that grows independent of what any single quarter looks like for trading activity. Futures, event contracts, banking services, and index investing tools are all expanding the product footprint further. When you combine all of this and look at the Rule of 40, which adds revenue growth percentage to adjusted EBITDA margin, where most growth businesses aim to land above 40, Robinhood is sitting close to 100%, growing at around 42% while running EBITDA margins near 56%. That is more than double what most investors would consider excellent. The company is generating real cash, buying back shares, and simultaneously cutting workforce by about 10% to stay lean and accelerate product development. With both Anthropic and OpenAI expected to hold enormous IPOs ahead, the engagement flywheel on this platform has a lot of spinning left to do. Moving to stock number 2, CoreWeave, ticker symbol CRWV, and I want to be clear about how I frame this one, because the way you think about it really does determine whether it belongs in your portfolio. CoreWeave is what the industry calls a neocloud. They have built out massive computing infrastructure by acquiring GPUs primarily from NVIDIA and rent that processing power to AI companies that need it to train and run their models. Revenue is growing from roughly $980 million to over $2 billion this year, and projections take that to over $5 billion the following year, representing 143% revenue growth in a single 12-month period. Gross margins have compressed somewhat as the company scales aggressively, but are projected to recover back into the mid-60% range as depreciation stabilizes. That mirrors the economics that eventually made cloud businesses at Amazon and Google among the most profitable operations in the world. The revenue backlog is the detail that genuinely stops me. CoreWeave holds $98.8 billion in remaining performance obligations, real signed contracts with companies including Meta, Anthropic, and OpenAI, locking in revenue for the next 5, 6, 7 or more years. 1 year ago, that backlog sat at $14 billion. From $14 billion to nearly $99 billion in 12 months. That is not incremental progress. That is a fundamental reshaping of the forward revenue picture. There's also a near-term catalyst worth knowing about. CoreWeave was just announced as a new addition to the NASDAQ 100, taking effect June 22nd. Any passive fund tracking that index is required to purchase CoreWeave shares as part of their mandate, and that institutional rebalancing continues for weeks after the initial date. That is forced buying pressure arriving in a compressed time frame. Now, I have to be honest about the risk because skipping it would be doing you a disservice. CoreWeave carries significant debt. When you calculate enterprise value rather than just market cap, the true cost of owning this business climbs substantially once you factor in their obligations. They are borrowing aggressively because operating cash flow alone cannot fund the expansion their signed contracts demand. Management has laid out the model showing how contracted revenue services that debt and still produces profit, and the logic holds together. But execution risk, interest rate exposure, and GPU supply access are all genuine variables. If you are more conservative, the established hyperscale cloud names give you AI infrastructure exposure with far less balance sheet risk. But if you want a pure play, high conviction position in AI infrastructure at scale, CoreWeave is as direct as it gets in the public markets. Third on this list is Palantir Technologies, ticker symbol PLTR, and this company becomes more interesting to me with every quarterly report I go through. Palantir builds decision intelligence software, tools that allow critical institutions, whether military operations, hospital systems, emergency response networks, or energy infrastructure operators, to process enormous data volumes and make decisions with a level of precision that general-purpose AI models simply cannot deliver. There is a meaningful difference between a system that gives you a high probability prediction and one that delivers operational certainty in environments where getting it wrong is not an option. Palantir has positioned itself firmly in that second category. Revenue growth has gone from 12% a few years ago to 84% recently. And this is not a deceleration story, it is an acceleration story. Both government and commercial segments are growing simultaneously. But the metric I keep coming back to is net dollar retention, running close to 150% in recent quarters. That means existing customers are spending approximately 50% more than they did the year before. The year prior, it was 125%. They are layering growth on top of growth on top of growth. Over a decade of following equities, that kind of compounding retention is something I have genuinely almost never come across. Revenue backlog is expanding at around 133% year over year, growing even faster than revenue itself. Net profit margins hit 53.6% last quarter. Free cash flow margins above 54%. The balance sheet holds $8 billion in cash with zero debt, a position almost certain to be returned to shareholders through buybacks or dividends going forward. The stock has pulled back considerably from its highs, which has brought valuation down to much more defensible levels. Rule of 40 sits at 145%. Drop a comment below and tell me, are you already in Palantir, or has the valuation kept you watching from the sidelines? I genuinely want to hear from you. Number 4 is Reddit, ticker symbol RDDT. And this one surprises people when I bring it up, but the financials make it hard to argue with. Reddit has been compounding at 70% plus revenue growth for multiple consecutive quarters. Gross margins have climbed above 91.5%. Net income went from $26 million per quarter last year to over $200 million this year. Free cash flow margins approaching 47%, bringing in over $311 million in a single quarter. These are not the numbers of a platform slowly figuring itself out. These are the numbers of a business that found its model and is scaling it hard. 3 growth engines are worth understanding here. First is search monetization. A growing segment of consumers are deliberately turning to Reddit for authentic human opinions on products rather than algorithmic results or AI-generated summaries. As Reddit builds its advertising infrastructure around that intent, including partnerships with companies like Shopify to improve conversion, revenue per visit will climb. Second is international expansion. Reddit is now available in over 30 languages, and most of its current growth is coming from outside the United States. International average revenue per user has moved from 46 cents to $2. For US users, it went from around $2.42 to over $9. The runway on those international numbers alone is enormous. Third is the authenticity angle. As AI content becomes more pervasive, people will increasingly seek spaces where they can access real human perspective. And Reddit has spent 20 years building the infrastructure for exactly that. Wall Street consistently underestimates this company's earnings, which creates significant positive re-ratings around quarterly reports. That is precisely the setup where long-term investors can build positions ahead of the market catching up. On a forward free cash flow basis, the stock is trading around 22 times, which for this growth rate is genuinely attractive relative value. If you are finding this useful, please take a second to like this video. It genuinely helps this content reach more people, and I appreciate every person who does. The fifth stock is Alphabet, the parent company of Google, ticker symbol Google. This might feel like the obvious large cap pick everyone already knows, but let me walk you through why it remains one of the most compelling situations in the large cap universe right now, particularly around dimensions that do not always get enough attention. Google Cloud just delivered $20 billion in quarterly revenue, growing at 63% year over year, operating at a scale that produces $6.6 billion in operating profit at 32% margins. The forward pipeline is where the story really accelerates. The cloud backlog expanded from $92 billion to $467 billion in a single year. The revenue they have already contracted is at a completely different order of magnitude than where current quarterly numbers sit. And that gap is what makes the multi-year growth trajectory so durable. Google Search is still growing above 19% and generating $60 billion per quarter. That is not a business fading. That is a mature franchise that found renewed acceleration in the AI era. Then there's the hidden portfolio. Alphabet owns roughly 14% of Anthropic and around 6% of SpaceX. As SpaceX's valuation has climbed toward $3 trillion, the mark-to-market appreciation on that stake has produced what amounts to a multi-hundred times return on the original investment. And those gains are flowing through non-operating income in a way that will only become more visible over coming quarters. Capital expenditures ran above $35 billion in a single quarter, up over 107% year over year. And the company just raised $85 billion to fund their AI build-out even faster. Free cash flow has compressed as a result, but this is deliberate strategic investment in a market growing faster than anyone originally projected. Rule of 40 near 64% and trending upward, with a valuation that continues to look reasonable relative to the quality of what you're actually buying. And then the sixth name is Meta Platforms, ticker symbol Meta. And I will tell you plainly, this might be the most misunderstood stock on this entire list relative to its actual fundamental quality. Meta just reported 33% revenue growth, bringing in $56 billion in a single quarter. Net income margins hit 47.5%, producing $26 billion in profit. Free cash flow came in above $13 billion. By any conventional financial standard, this is one of the most profitable businesses operating on the planet. So why has there been selling pressure? Almost entirely because daily active users showed a slight sequential dip in one quarter. But the cause was entirely driven by internet disruptions in Iran and government restrictions on WhatsApp in Russia. Both temporary, both already reversing, neither having anything to do with the underlying platform health. Those users are coming back. Meanwhile, Meta just disclosed that Threads has crossed 500 million monthly active users, a new platform at enormous scale that has not yet been meaningfully monetized, representing future revenue upside sitting entirely outside current financial models. The core advertising business continues to accelerate on multiple dimensions. Impression volume growing, pricing per impression growing, AI-powered targeting improving conversion, which creates a reinforcing cycle where advertisers get more value and pay higher prices. Meta is also building across AI tools, augmented reality, and social applications in multiple categories, and the company has a documented track record of entering new spaces and eventually dominating them. The stock is currently trading at just 20 times earnings, and on a forward basis, closer to 17 times. That is a company generating $26 billion in quarterly profit, at the kind of multiple you would normally see attached to a slow-growth industrial business. That disconnect between valuation and fundamental quality is exactly what patient investors should be looking for. So there you have it. 6 companies, 6 distinct risk profiles, 6 growth stories, but all of them sharing a common thread of compounding fundamentals. The market is not fully pricing in right now. For more conservative investors wanting large-scale AI exposure without elevated balance sheet risk, Alphabet and Meta stand out most clearly. If you want platform plays combining fast growth with real profitability, Reddit and Palantir make a compelling combination. And if you have the risk appetite for high-velocity positioning in AI infrastructure, both Robinhood and CoreWeave deserve serious research time. None of these are without meaningful risk, and nothing in this video is financial advice. Always do your own thorough research and consult a qualified financial advisor before putting real money to work. What I would love to know from you is which of these 6 names you find most compelling, or whether there is a company you think I should have included on this list. Drop it in the comments. I read every single one, and those conversations are one of the best parts of doing this. If you found this useful, share it with someone in your circle who follows the markets. And if you're not yet subscribed to TickerHawk, right now is the time. Hit the button, turn on notifications, because we have more deep dive content coming that you will not want to miss. Thanks for being here today. See you in the next one.